All right, good evening, everyone, and thanks for joining us here at the Business School for our program on blockchain and traditional finance. This event is organized by the Brigger Family Digital Finance Lab, which is part of the B School's Digital Futures Initiative. The Digital Future Initiative is Columbia Business School's new think tank focused on preparing students, executives, and partner organizations to lead through the next century of digital transformation. The Brigger Family Digital Finance Lab is led by our own William von Muffling. Did I pronounce that right? Muffling, professor of business, CMAC Moalemi. And it's focused on decentralized finance, or DFI, which is changing the core functions of our financial markets. My name's Todd Baker, and I'm a senior fellow at the Richard Paul Richmond Center for Business, Law and Public Policy. And I'm an adjunct professor as well at the law school, where I teach a course on fintech, business models, public policy, and regulation to law students and business students. So we've got a great panel of experts tonight who I'm going to be introducing shortly. But first, I thought I might share a couple of thoughts about what we'd like to accomplish here tonight. As you're all aware, the emergence of distributed ledger technology, blockchains, and decentralized finance over the last few years have been the source of both great interest and considerable drama. By offering powerful new alternatives, combining ideas from computer science, cryptography, and economics, blockchain technology has thrown down a conceptual challenge to the design and infrastructure of traditional financial markets, which have remained unchanged for many, many years. While Bitcoin and crypto trading ecosystem have been the most active application of blockchains and have captured most of the headlines, and recently very negative headlines, there has been a lot of quiet work going on the software and finance industry side, seeking to apply the technologies that underlie the crypto phenomenon to create products and businesses that will improve the way traditional finance works. Our goal tonight is to explore what these new technologies can do to improve traditional financial services, while also exploring some of the business policy and governance constraints that may impede the adoption of these technologies in a heavily regulated space. I hope we'll all come away with a measured view of where blockchains can provide real value for the future. Now I'll briefly introduce our panelists. At the far end, or second to far end, is Tom Brown, who's a partner and general counsel at NICA Partners, a fintech-focused venture capital firm. Before joining NICA, Tom spent 25 years as an attorney and angel investor in the fintech space, as well as being for many years the leading U.S. lawyer in the area of new financial technologies and antitrust. Aaron, at the end here, Aaron Brown, spent 40 years on Wall Street as a trader, portfolio manager, head of mortgage securities, and risk manager for major global financial institutions, including AQR Capital Management, where he was managing director and head of financial markets research. He has actively invested and participated in crypto projects since 2011. He's a columnist for Bloomberg and Wilmot Magazine and teaches an adjunct at several universities. Morgan Krupetsky is the Director of Business Development for Institutions and Capital Markets at Ava Labs, a company supporting the development of the Avalanche public blockchain and projects building on that platform. Before joining Ava Labs, Morgan spent 12 years in traditional finance at Citi on the institutional FX and macro sales desk, covering hedge funds, asset managers, and pension funds, before transitioning to become chief of staff to Citi's chief compliance officer. CMAC, who you all know, is the William von Muffling Professor of Business at Columbia Business School and the director of the Brigger Family Digital Finance Lab. He needs no further introduction to those of you here, so I won't make one except to say that his achievements and awards in the fields of engineering and finance, both practical and academic, are deeply impressive and quite intimidating to the rest of us. We're going to give each of the panelists 10 minutes to lay out their view of the potential for blockchain and traditional finance. Then I'll present some questions to the panel, followed by audience Q&A. So let's start with CMAC, followed by Morgan, Aaron, and Tom.
Thank you for the very kind introduction. My research is quite heavily focused around quantitative finance. And for a number of years, I've been really interested in things like quantitative trading, market microstructure, and so on. And over the past 5 years, I've got quite interested in blockchain as kind of a fundamental new sort of abstraction, combining ideas from economics, computer science, cryptography, and so on, as a platform to implement some of these sort of ideas. So As I have thought about things in blockchain and sort of contrasted them with how things work in traditional financial markets, I do find that there is a lot of innovation. And a lot of it is just simply because the technologies are newer and were developed with like sort of a clean slate and don't have a lot of the baggage of how things evolved historically or various kinds of path dependencies and so on. So I think in order to maybe sort of illustrate some of these and some of the advantages, I've sort of made a list of a number of ways that blockchain does things better, and I'm going to proceed in order from I think maybe the least interesting improvements to sort of maybe the most interesting. So to start with, a very common function in financial markets is settlement, right? If I want to let's say buy a stock, then I have to, at some point you have to exchange your money for that stock. Or if you want to pay someone, maybe you use something like a wire transfer, or ACH, or so on. Our settlement systems are quite primitive, right? Like the stock market, the amount of time it takes to settle a trade is 2 business days. And this was a big improvement. I mean, it took like, I don't know, 10, 15-year effort to go from 3 business days to 2 business days. And now, maybe in another 10 years, we'll go to 1, business days. And that's not even the worst of it. If you want to do something that's a little bit more complicated, for example, if you want to move you have a bunch of stocks in one brokerage account, you want to move it in another brokerage account. Well, guess what? You got to fill out a long paper form. You got to send it to your broker. You're going to wait 2 weeks, and sort of maybe you'll hear back. So, this is very primitive relative to sort of the blockchain kind of world where in most sort of systems, settlement can be real time if you want it, right? So and visible to everyone and auditable and so on. So that's sort of the starting point. But I don't even think that's necessarily the most exciting. I think that the next level is when you sort of think about features of the blockchain world, and 2 of the most important features are I think in general openness and transparency. Right, so in terms of openness, I'm thinking of things of like access to data. Right, blockchain world, certainly almost all the blockchains we see today, by definition, the data is open. Right, by definition, you can see what was traded when, and so on and so forth. To contrast, in traditional financial markets, that data is very tightly held. Modern exchanges, for trading equities and so on, the way they actually make their money is selling data. So it's not so much that they actually make money off the transactions. They make very little off the transactions. But what they do is then they sell the data downstream, and they make enormous amounts of money through that. And in some ways, you can view these as like, basically regulation-sponsored monopolies. Because essentially, for example, if you're trading U.S. equities, you have to buy data from the New York Stock Exchange. They're almost free to charge effectively anything they want. Again, in contrast to the blockchain world where, to a large extent, things are open and free. So, that's the data side. The second side of I think, openness and transparency is how the mechanisms work, right? A great thing about the blockchain world is if you want to understand, let's say, how a certain lending protocol works or a certain decentralized exchange works or so on, you can look at the source code. Right, you can understand it if you're not a coder and you're curious enough. Maybe you can hire someone to try and understand it and to audit it. To contrast that if you want to know how NASDAQ works in terms of how they match buyers and sellers, good luck. Right, they don't publish it. Right, maybe high frequency traders spend a lot of time sort of experimenting, trying to sort of figure that out. But those are sort of fundamentally opaque systems. And so, moving on from opaqueness and transparency, again, moving to sort of, more interesting things, a great feature of modern blockchains is composability, right? The idea that you can combine different financial services in different ways. You can sort of mix and match, create things that didn't exist. This is very difficult in the traditional world. Let me give you an example. Suppose you want to monitor your portfolios and your spending and so on. Maybe you have a handful of investment accounts, you have a bank account, you have some credit cards and so on. It's really nice to get sort of a unified view of that. There are services that provide that. For example, Mint from Intuit provides that service. You know how Mint works? You give it all your banking passwords. You give it all your banking passwords, and then it connects to your accounts online, And that's the way they cobble together a service. It's kind of ridiculous that you need to operate in that kind of an ad hoc way. Let me give you another example. Suppose that you own a bunch of stock and you want to borrow money against it, right? This is commonly known as a margin loan, right? So the way things currently work is your stock will be at a brokerage account, and the only person who can lend you money against that is the brokerage. Right? There's no reason that needs to be the case. There's no reason that, for example, the person who you use to buy and sell stock needs to be the same person as the person who lends you money against stock. In a world where you have greater interoperability, where it's easy to transfer assets, where it's easy for services to interact, we don't have to live with these limitations, and we can have new and different services. But again, thinking towards the long term, more and more in finance, but also more broadly through society, we're going to be in an environment where we're increasingly interacting through information technology. Right, and so we'd like that technology to be sort of modern, and we'd like to have modern rails for things like payments and settlements and so on, and we really don't have that in finance, right? So I mean, you could look at maybe certain exchanges are very technologically sophisticated. Maybe certain banks, parts of them are technologically sophisticated. But the whole system, especially the deeper you dig down, again, is a lot of manual processes where we still live in a world where Excel spreadsheets are emailed on a nightly basis in order to sort of exchange data, and we're not benefiting from all the advances that come from technology. So one model forward, and this is likely to be sort of the non-blockchain model, is what I call the SaaS model, which software as a service, and that's to some extent the way the rest of the tech economy works. You have these large platform companies like Apple or Amazon or so on, and they provide APIs and endpoints, and you can there are ways to sort of programmatically have these platforms interact with which don't involve technology like the blockchain. But we also are all already familiar with the downsides of that, which is when you have these large kind of centralized platforms, what you end up with ultimately is monopolies. Right, and so you have a monopoly with Apple in the App Store. You have a monopoly with Google with display advertising and so on. So yes, they're able to leverage a lot of the benefits of this information technology, but they also keep a lot of that to themselves. And I think the potential for blockchain is to provide an environment where you're interoperable and different services can connect and new services can create it and so on, but that isn't owned and sort of fundamentally controlled by anyone, and hence is protected from this type of monopoly rent extraction. Now, that's not to say that all is roses in the blockchain and crypto world, and of course we all know that seeing the headlines. There are fundamental issues that need to be addressed. So in my mind, for example, a fundamental issue thinking about DeFi is security. Right, you don't follow the crypto news for more than a week without hearing about someone stealing $100 million there, $200 million here, or so on. So that's a major issue that we don't seem to have in the TradFi system. So TradFi wins on that point. That's something that needs to be addressed. Also, I think a lot of what we see in the news is in some ways the worst of both worlds, right? So you see entities like FTX or Celsius or so on. On the one hand, they're not really decentralized. They don't operate on the blockchain. They are centralized and opaque and so on. On the other hand, they're also completely unregulated, right? So in some ways, that's kind of the worst of both worlds. And that is obviously something we don't want to import in the TradFi world. So all these problems aren't solved. But again, as we sort of project forward, we do need to imagine ourselves going into a world where we can leverage technology more and more. And in my mind, blockchain has the potential to offer a neutral platform to do that.
Great, thanks. Morgan, you're up.
I think you just went over everything.
No, come on. You have something clever to say, I'm sure.
Yeah. Can you guys hear me? So I need to say a disclaimer first, just to say that, sorry, hold please. Okay, none of this is an endorsement by Avalabs, the Avalanche Foundation, or any of their respective subsidiaries or affiliates, nor is any of this investment or financial advice of any kind. Do your own research. If you have any questions, happy to chat after the presentation. Cool. So again, I'm Morgan Krupetsky, Director of Business Development for Institutions and Capital Markets at Avalabs. Again, Avalabs is the company supporting the development of the Avalanche public blockchain. Again, was in traditional finance for 12 years at a bulge bracket bank before I made the leap into the more kind of crypto native space. But in my role, I partner with a really wide variety of financial services institutions. So partnerships with all the big banks, asset managers, hedge funds, private equity firms, venture funds, really as they learn about and build on and use the Avalanche blockchain in some way, shape, or form. We spend hours and hours and hours kind of in deep dive discussions with institutions about the capabilities of our technology, their various use cases, and potentially how Avalanche could kind of fit those needs. I say that because I joined Avalabs on May 2nd, which was right before the first of several ensuing industry-related implosions that have come after. So my timing was definitely impeccable in that sense. But all that's to say, as I've actually been extremely pleasantly surprised over the past several months at how progressive many institutions have been and continue to be in their respective blockchain and digital asset initiatives. There's many groups within these companies who, quote unquote, get it, and who've spent the past several months really educating their teams internally, their boards, their clients, their stakeholders about really the nuances between what was kind of mentioned, the actual technology that has really revolutionary capabilities in really transforming legacy systems, intermediaries, and ways of working, versus kind of most of what's transpired over the past several months, which, again, frankly, has been focused on the realm of centralized finance, or CFI, and ultimately has proven out that, you know, the industry is kind of crying for regulation, particularly around things like consumer protection. And really the reason why we've had a lot of these laws, rules, and regulations in place in the traditional financial services space for years now. Just kind of before we get into this, just to kind of take a step back and just take a few minutes to review at a high level what the Avalanche blockchain is and how Avalabs kind of fits into that within that picture, and then we'll kind of review how institutions are engaging with the platform. At a high level, Avalanche is a layer 1 proof of stake blockchain with smart contract capabilities. At its core, it's public permissionless blockchain. It's open source infrastructure for anyone to really use or build on. They don't need us. Anyone can kind of go look at the code and decide to build and deploy different applications and use cases on it. And at this point, there's many applications and partners kind of building on Avalanche, from DeFi, NFTs, gaming, enterprises, exchanges, wallets, in other types of infrastructure and financial services institutions. Avalabs, again, is a software company really building the infrastructure tooling and partnerships to really drive forward the growth and adoption of the Avalanche blockchain. Overall, at a high level, we have really kind of deep academic roots and really an amazing mix of academics, engineers, and business people. Our founder and CEO, Emin Günsir, has been in the space for seemingly forever. He was a Cornell computer science and distributed systems professor when he set out to build the platform, and today he really continues to be an active advisor to Fortune 500 companies, government, central banks, blockchain companies, and really everything in between. And from a business perspective, between our president, John Wu, our VP of BD, our head of DeFi and developer relations, myself and others, we really bring a collective multiple decades of experience in the buy and sell side. And all that's to say is we've been extremely focused on really cultivating high-touch, trusted advisor relationships with various types of financial services partners, really as they kind of go along their journeys. Interestingly, the concept of asset tokenization, which really enables some of the things that were kind of reviewed from a efficiency standpoint. This has really gained an increased attention among crypto native and the traditional financial services industry over the past several months. But as a company, our mission has actually always been to digitize and tokenize the world's assets. Just at a high level, just to review, asset tokenization really refers to the process of converting ownership rights into a digital token on a blockchain, and can be applied really from everything from regulated financial instruments like stocks and bonds to tangible assets like real estate or commodities to IP around music and film and so on. So why have we been focused on this? The idea is that blockchain rails can really help create greater efficiencies and cost savings and transparency, particularly when it comes to being compared with legacy systems, infrastructure, and ways of working, and can ultimately make asset tokenization the means by which we can ultimately democratize finance. And what I mean by that is really enabling borrowers to more easily tap into capital markets and access wider sources of funding, and at the same time present individuals and institutions with greater and more diverse investment opportunities and access to various types of asset classes. At a high level, benefits can really be realized across various stages of the asset management lifecycle. So everything from asset issuance and KYC and onboarding and compliance to administration, verifying loan performance, not on an Excel spreadsheet or 50 days delayed via PDF, but more so in relative real time. In secondary market trading, in terms of really enabling a greater number of buyers and sellers to engage in secondary market trading, particularly when it comes time to talk about like private market securities, as well as, again, incorporating these things into on-chain DeFi, meaning using these things as on-chain collateral to actually put historically trapped or illiquid positions to work, as well as in clearing and settlement. And I know it was mentioned it wasn't an exciting use case, but coming from the world of FX, where things settled in T+1 to T+2, and seeing the amount of potential trade errors with manual trades and confirmations, it's the frankly revolutionariness of it, I don't think can be understated, although I don't think that's a word. So today, and I think, and just to say, I think ultimately because of all these benefits from a cost and efficiency standpoint, what you're seeing is that smaller transaction sizes, both from an asset issuer standpoint as well as from an investment standpoint, these transactions are made more economically viable because of all the efficiencies that you can realize kind of pre, during, and after the trade. So this point is really kind of to hone home the fact that ultimately we're all trying to kind of democratize finance, democratize access to finance, but it's really using the blockchain rails to enable smaller, more palatable, fractionalized, whatever you want to call it, deal sizes to really kind of open up capital markets for both asset issuers and investors, individuals, institutions, so on. So in general, I'd say, and we're seeing this more and more in the headlines, that we're seeing more and more executives within the traditional financial services industry really pointing out the benefits of asset tokenization. And just to say that this is totally separate of straight cryptocurrency trading, of the implosions in CeFi, of other kind of industry developments over the past year, particularly when we're talking about things that are very clearly security tokens. Generally, people don't try to obfuscate like the laws, rules, and regulations that are already in place to be able to issue and trade these tokens. And institutions are really increasingly exploring using blockchain rails and self-executing applications, or dApps, to tokenize assets, to really upgrade siloed and antiquated infrastructure, to really power the next generation of financial services. There's obviously many examples over the past year. A notable example from an Avalanche standpoint was private equity firm KKR had tokenized part of their recent healthcare growth fund on Avalanche, which essentially tokenized a feeder fund in partnership with Securitize, who has a requisite broker-dealer and RIA and transferred agent licenses, to ultimately enable qualified purchasers to directly buy into the fund with much lower than average investment minimums. So that's an example, but obviously there's many more. And ultimately, more and more today, we're working with institutions to deploy their different use cases on Avalanche subnets, which are really the way that we have always intended to scale, which is horizontally through adding, basically you could think about them as application-specific blockchains, which really allow them to benefit from the best of both public blockchain infrastructure and a lot of the kind of enterprise blockchains that you may have heard about, that a lot of them are used to building on. So ultimately, down the line, the idea is that more and more, if not all assets, will eventually be tokenized in many years. And we'll just refer to them as assets, not tokenized assets, not real-world assets, not off-chain assets. They'll just be the new version of assets, and that more and more financial services and processes and infrastructure will move on-chain to the point where we're not necessarily delineating between TradFi and CFI and DeFi or OnFi. It'll just be finance. And obviously, we're still early, but I think, again, in our discussions with different institutional partners, it's been very encouraging to kind of see their progressiveness in the space, them moving forward with their respective initiatives, and really kind of understanding maybe compared to years past or in other cycles past where I think before they were kind of questioning the legitimacy or validity or use cases of the tech. Now it seems like we're in a next kind of paradigm where they're really, really pushing ahead. So I'm very excited. Would love to talk to anyone who wants to learn more, but that's it for me.
Great, thank you, Morgan, that was wonderful. Aaron, you've spent a long career in every aspect of traditional finance, and now you're all in on the new technology. So tell us how you think about it and what's driving your investments and other activities in this area.
Okay. I've actually been all in on it for quite a long time. I was born in 1956, but at age 22, I was born again. I came across this article in Scientific American by a guy named Martin Hellman called Public Key Cryptography. And I had by 1970 standards, a very good education in information theory and computer science and private key cryptography, and never had anyone had the slightest hint that this kind of stuff was possible. This was eye-opening for me and for many people of my age and generation. This was the first we had ever heard of these ideas. I was at the University of Chicago at the time in the finance PhD program, and another guy named Ron Rivest, you may not recognize the name, but he put the R in RSA about 10 years later. And he gave a seminar on public key cryptography, which he called Mental Poker. He published that as a paper a year later, and that's another old paper that's worth rereading even today. I was a professional poker player at the time, and I loved the talk, and I talked to him afterwards. I said, you've solved half the problem. You've showed us how you can do the card shuffling and decide who wins the hand, but you haven't told us how you can transfer the money. And he had also been thinking about that. We had a long conversation. We came up with Bitcoin. We adopted the name Satoshi Nakamoto. We were light years behind the 2008 Bitcoin white paper. But the point is, we were thinking about this stuff. And over the decades, I had conversations with hundreds of people who were thinking about the same kind of thing in different ways. The moral here is twofold. First is these clever mathematical visionary ideas do sometimes come to fruition. The second point is it can take most of your lifetime to do it. So I'm going to talk about a few more kind of visionary, clever mathematical ideas that have not yet come to fruition. I think they will. I can't guarantee it won't take 40, 50 years for it to happen. And the key to me, I approach this like an economist. We're used to the idea of money exchange, but don't often think about the fact that the most important things in life are exchanged, right? We earn trust, we repay loyalty, we reciprocate affection, but not with or for money. We have social mechanisms of exchange. We have gifts, we have favors, we have sex, all of which have very complex social rules. Money is sometimes involved, but not in the direct, fee-for-service way, or if so, sometimes with regulatory consequences. We often don't think business entities insulate themselves, for the most part, from the money economy, right? Employees don't rent their offices. They don't get paid per, memo they produce. Businesses have their own internal record-keeping, budgeting, incentive structures that are not directly money. They sort of wall off the money. They only use money with inter-entity transactions. Then we have parts of the traditional economy that never fit very well with money. Intellectual property, lots of legalistic stuff, lots of lawsuits, very inefficient protections. Media, right? Most of it is supported by advertising. There's regulation and intense legal structures, and they tend to be wedded to the physical. So, you know, record companies would sell you a physical record, but it was very unclear kind of who owned the music. A lot of them, when the technology changed, the business model is sue your customers. Social networks. If you had asked somebody 25 years ago, what's the economic value of social networks? You know, bulletin boards, flyers, all the kinds of things people did to broadcast social information, somebody might have said $10 million, $20 million. Once it was built, it turned out to be trillions. So there's tremendous value out there that could be exploited if we had more efficient exchange mechanisms, if we had more sophisticated ways of making exchange, what you might call metered exchange, than money. So I want to focus on, at a very broad level, I think there's sort of three conceptions of cryptocurrencies. The first is like foreign exchange. The cryptocurrency is just another currency. You know, Bitcoin has a value in US dollars. It's linear, at least locally. You can buy Bitcoin for dollars. And the exchange rate may be dynamic, but basically it's just another way to hold value. And my feeling about this is these are definitely currencies, but they're not essentially crypto. And in fact, the history of the last 15 years has been every time crypto scores a major success, like international money transfers, what happens is traditional financial institutions duplicate it cheaper without using the crypto technology. Or in the case of something like Silk Road, it gets shut down. So this, I don't think, is the future of cryptocurrencies. It's very important. There's a lot of useful stuff you can do here, but this is not what's going to drive the future. The second is tokens, where you have something that's entirely internal to a project. It's got some clever game theory to incentivize people in certain ways, but you can't buy or sell the tokens for money. They just work internally in the system. Again, I think this is very valuable, but it doesn't scale. And it has the chicken and egg problem. There are enormous barriers to entries for users to get really familiar with crypto, for users to really understand crypto. None of these are big enough, compelling. We have no killer app that is important enough to get hundreds of millions of people to use this. I read somewhere there are 1 billion users of cryptocurrency in the world, but virtually all, first of all, I have no idea if that number is right, but virtually all of them either use one crypto for one specific purpose. They use Bitcoin to transfer money, out of the country back to their family at home, or they're just speculating or trading in it. The number of people who really use cryptocurrencies, and the most important thing is, are receptive to new crypto ideas without a huge on-ramp expense, I would say is more like 10 million. And that is just not enough. We need a killer app that gets hundreds of millions of people to sign up and use crypto and understand it. That lowers the barrier for everybody else, and suddenly you could have a flood of projects. But we're waiting 15 years. I keep thinking someone's going to have one, but it doesn't seem to happen. I think the most interesting and the future of cryptocurrency is the hybrid. These are systems that use tokens that internally work with the token that allow some exchange for other currencies, for dollars or for Bitcoin or for euro, but in nonlinear ways, in complex ways. And this is something that revolutionizes both finance and economics. Macroeconomics is based on general equilibrium models. Most of finance is based on limited arbitrage. Both of those concepts only make sense if things are at least locally linear. Once you introduce significant economic value controlled by nonlinear exchange rates, you get far more complex economic and financial behavior. So this is where I think the action is in the future. Well, what is the future? Well, again, three more things in here. I'm not going to name a favorite. We could do add-ons to traditional financial entities. And with all due respect to Morgan, Avalanche is going to existing businesses, existing financial companies, saying we can do what you do better with this crypto technology. In some ways, that's a low-hanging fruit. That's the way, that's most obvious to get funding. That's the way where you have sort of the most immediate payback for things. And that may accustom people to crypto, and that might open the field for more radical ideas. Then there are traditional businesses that work better to crypto. We may see that movie production, that music, that book publishing, these industries just move to a crypto basis. Sex, pornography, gambling, all of these things are things that might move to crypto, and enough people like them, enough people are willing to follow them, that's where the inroads get made. And finally, the most exciting, but also the most visionary and the least likely to implement, at least in the short run, are entirely new services that were either unpriced or impossible without crypto. So this is the social media is sort of the example of something like this, where people really didn't even think of it as a service that was worth money, and suddenly it's a big part of people's life. With average person spending 4 hours a day on the thing, on something that 25 years ago nobody spent any time on. So that's what I know this isn't very helpful for anything specific, but I do think these hybrid projects in one of these three areas is what's going to drive the future of crypto.
Great, thank you, Aaron. And I'm quite sure that you and I are the only people who get the time tunnel reference in your slide deck. No one remembers James Darren anymore. So, Tom, you are both an investor and one of the leading lawyers in the country in this area. What do you think's happening?
I think that's a great question. And since Todd knew that I hadn't actually prepared any remarks, he gave me the lovely opportunity to go clean up for all of you. Thank you, Todd. Can always use the additional 10 minutes to prepare. So I think my thoughts actually align quite a bit, I think, thematically with everyone's, and particularly Professor Seemack.
CMAC,
Yeah. In that you have to start with some definition to I think, anchor yourself in crypto and what is or maybe is not interesting. And so I've been trying to come up with some, since I'm a lawyer, very simplistic way of organizing thoughts around what is or is not interesting about crypto. So this is like the classic business school 2x2, right? I didn't go to business school, so you have to bear with me. Okay, so we need some dimensions to think about how we distinguish crypto from non-crypto. And I think when we're talking about crypto, what we're really talking about are not cryptography in the public key, private key cryptographic sense, but we're talking about, and we're not even talking about blockchains, because those are just data structures. We're talking about databases, right? And then we can think about, okay, so if we put just one database down here, AWS, and we put what we'll call, what I always call Satoshi, but way up there, like, what are the implied dimensions that distinguish those two things? This is a school, right? People ask questions and then people answer? Or is that just what they do at law school? Okay, so just law school. So I'll fill it in for you. So I think what we have, right, is private, right? I know there's some computer-y people in the room. Probably just can't go to any AWS instance and look up everything that happens to be stored there, right? Okay. And then, but Satoshi, right, is public. You can go and look at any block on any node, and they're all the same. So then what's the other dimension? Professor Seemack, I think, mentioned this, right? So it's closed and open in the sense that there are sort of strict rules that define how nodes on the AWS system are updated. And Amazon controls who gets to run those nodes, namely Amazon. The Satoshi blockchain is different. Right? Anybody can actually download and run a node. That's, in fact, the whole point of that. And most of the time when we're thinking about crypto, we're sort of sketching it on that sort of AWS to Satoshi dimension. But you can actually combine these things. There are examples of public closed systems. There are examples of open private systems. So that's sort of a start then in thinking about like what's then interesting about distributed ledgers. Probably all in this upper right-hand quadrant. And then what kinds of projects become interesting to think about there? I think of three things. One seems pretty obviously interesting. One may be interesting. One more speculative. And because it's speculative, at least some people, Todd, think that it shouldn't exist or is really crazy, but like it does kind of exist and that's kind of interesting, so we have to think about it. So what are those? So the first is identity. And this is where I think identity connects back to sort of cryptography. As we interact and live in a digital space, it becomes really, really important to be able to conclusively identify yourself to digital counterparties. And that, to me at least, means control of the root cryptographic keys that are used to identify you to digital counterparties and enable you to identify those corresponding digital counterparties. Like, if the crypto revolution, however we find it, has done nothing more than to make hundreds of millions of people comfortable creating and managing their public keys and private keys, like, score one for crypto. That's a big deal. So then what's the next one? And this is the thing that I've spent a lot of my life working on, payments, right? Actual exchange of value. Totally agree that existing settlement mechanisms are not awesome. But if we sketch the attributes of a crypto project on payments, not totally clear that we want it to be open and public with respect to all transaction attributes. And NICA has not invested at the fund level in any project where the expected return is based on appreciation of a token. The partner level, though, we have made one investment, and that's actually, we hold some of it. Because we think there are interesting things about other database organization and data structures. Okay, so payments maybe. Happy to talk about all the things that I think are super interesting about payments. Been obsessed with changes to the UCC that are rolling out across the country, but increasingly politicized. If you watched the governor's lovely presser from Florida yesterday, but anyway, we can come back to that later. And then the last, and this is where I think my thoughts tend to deviate the most from Todd, is like, we now have examples of projects that are anchored essentially around API keys. I mean, that's really all a unit of crypto is. It enables you to make some call on a database, to write or read on that structure. And then people have sort of organized around those incentive networks and created things. I mean, the Satoshi blockchain, the Bitcoin project, whatever you want to call it, is by any measure the most successful open source project in the history of the world. People have contributed enormous amounts of energy, time, and power to creating and managing Bitcoin. Like, that's kind of interesting, and at least for somebody like Aaron, no relation, who also went to the University of Chicago, makes me think about incentive networks and organizational structures. And I sort of wonder whether it provides new ways of managing people outside of what I used to think of as the Coasian duality, right? So anyone here study Coase? He did actually go to Columbia too, I think, right? But I think he's also one of those Columbia, Chicago people who are like extremely unusual. That would be me. Anyway, so Coase wrote The Theory of the Firm. And that is a study in when do people organize themselves around market transactions and within hierarchies. And what's interesting about the Satoshi Project, it is neither of those things. To the extent that it resembles anything, it sort of resembles how we organize in civil and civic society. And I think that's kind of interesting and makes me somewhat optimistic about our digital future. So anyway.
Great. Thanks. So we got a lot of different perspectives here. I'm going to start off by asking some questions and to the panelists, and then we'll get to audience Q&A. So the first is sort of the standard skeptic question, which is there are people who say in the computer science field who suggest that while blockchain is new and interesting, it isn't that great a practical technology. And a spokesman for this would be Stephen Deal, who would say, there's fundamental limitations to the scalability of blockchain-based technologies, and in his view, every use case is better served by another simpler technology. What do you think of that critique of the the clunkiness of blockchain-based solutions?
Well, are you thinking specifically of proof of work?
I don't know what he had in mind when he probably was talking about that.
Every single specific implementation has its limitations, right? So there are pros and cons of different ones. I think.
Aaron, could you put your? I think it's not.
Your mic isn't on. I think you got to turn on the data.
Right. Sorry. Yes. Okay, is this better? Yes.
Much better.
Okay. But I think the field is rich enough that people can come up with technical solutions appropriate to all the different tasks people want to use. There's probably no one blockchain that works for everything, but there are infinite variations possible.
Another sort of related, more of a business problem has been the idea that even assuming that blockchain is faster, cheaper, better, if we just take that as a generalized assumption, how are organizations, particularly in financial services, going to deal with the transition? Since obviously, there's a sort of an innovator's dilemma problem here, which is you've got a huge investment in existing infrastructure, and you want to do something that's the same, meaning the same business you're trying to run, but you now would have to do it in two ways. How do you think a business as general can manage the transition? Maybe I'll kick that to you, Siamak.
Yeah, I think that's a challenge, and I think there's a deeper challenge in that, at least in a lot of the financial applications, there are benefits to the current structure for businesses. In particular, various types of oligopolies that exist in different parts of the financial world, where people benefit really from a lack of interoperability and so on. So I think that's a real challenge. I don't know how that's going to play out. I don't know if others have views, but I think the adoption is going to have to come from the end users. Like if the end users demand it and threaten to go to competitors and so on, then I think people will modernize. But I think that's where the demand has to come from.
How do you see that question, Morgan? Because you're right at that point, right?
Given who I'm partnering with, I can't say total disintermediation, but I've always agreed with that view that I think a lot of it will come from dictation from allocators to funds and funds to banks. And as soon as the clients demand upgraded services of their current financial partners, they'll have to follow suit, or they're at risk of being disintermediated. So I think it'll probably be a combination of them upgrading their infrastructure and also potentially new players who have this blank slate to kind of come in and disentangle at least some of the ways of working. So I think it'll be a little bit of both, but a lot of the financial infrastructure, whether it was where I was at or other firms, is kind of, to your point, like a mixture of a lot of mergers, acquisitions, and systems that are piled on top of each other that don't necessarily talk to each other. And I think it's a, net, it's definitely time intensive, resource intensive, but ultimately, there's a lot of, I think, potential benefits. So I think it just depends on kind of where it comes from, but I think ultimately it'll be a little bit of both.
Let me follow up one more time, because one of the interesting things in my world is how many years the banking system has worked on terrible old technology and never been able to make the transition because it was just too expensive and too difficult for public companies to contemplate. So can blockchain solutions exist? Do they have to replace the core, or can they exist in a sense on top of or working with the more traditional, existing, more centralized financial services technical systems?
I think it could be a little bit of both, to be honest. I think from centralized exchange standpoint, I think some of that infrastructure will definitely be upgraded, where we may not necessarily need as many kind of either third-party intermediaries or service providers that it takes to kind of facilitate some types of products. But I think ultimately it might be a little bit of both, and maybe there's going to be like a transition period where initially it's kind of additive, and then ultimately it transitions to kind of being fully on-chain. But it'll probably take, especially since these are embedded financial institutions that have been around for many, many years. It's obviously not going to be an overnight phenomenon by any means, but I think that there's like a process.
I add in just you said it very politely, time and resource intensive. When I read that article by Martin Hellman, my day job was taking huge decks of job control language punch cards with COBOL programs and trying to, make them work. The lesson I learned, and my whole career has been, dealing with these legacy systems, it's incredibly expensive, and nobody understands it. Nobody anticipates it. There's actually a famous meeting. I was at this meeting, but I wasn't the leader. But it became a famous meeting at Citigroup, where Morgan worked, where the risk management team presented a $2 billion budget request, and Sandy Weil, the head at the time, said, "Can somebody give me $10 million risk management?" But that's the thing. Even the top executives had no idea how expensive it is to transition these legacy systems. And blockchain crypto is not immune to it. Bitcoin has trouble making even routine technical updates because the miners are so conservative. They can't risk being down for 5 minutes and losing one block. So, it's not like we're going to put in this new technology and suddenly legacy updates will be cheap. Maintenance and will be cheap. It just cost of doing business.
I mean, don't we know academically how this is going to work? So you're either going to internalize the benefits as a single firm, or there will be a push from end users across all suppliers, right? Like that.
It seems to me that in many respects, for this to work, it's going to be harder to do it within the existing companies. And it really, this is why perhaps the successful innovators here are going to be those who start businesses, start just because the transition is going to be so difficult.
Yeah. I mean, I think that's if you're thinking, I guess now my job is thinking about how we allocate capital around these ideas.
Right.
I think that's the dominant investment thesis, right? So if you had, say, $100, right, like you're putting 90 into those that are sort of internalizing the benefits. But there is a sort of shoot the moon opportunity where if you can move the industry in the right direction in baby incremental steps that are backwardly compatible, you might actually get things to sort of flip. Like there was this point in time, I know because I've seen pictures, when most of the world's financial institutions manage their computation through, the word computer refers to humans, not digital. Like we had people lined up in large buildings who spent their day computing.
The moon.
using slide rules and such. And so then one day in the 50s, people woke up and were like, well, maybe we're going to have to use this new digital thing, and we'll slowly replace all of our human computers. And we did. And IBM made a lot of money.
And so it feels more like then you think we're going to get to a point where enough has happened that the momentum will shift and it will, like bankruptcy, will happen all at once, right?
Well, I think you can't, I think you just can't exclude that possibility a priori. You have to be open to that happening. Little nibbles at the edges.
So we've talked mostly about innovations that are, essentially replacing existing, doing better versions of existing financial services. Can this technology allow something uniquely different, something really that we've never thought about? Is it
Well, it
more
kind of-
inherently better able to do that or not?
I'm going to say that it kind of has with Bitcoin.
Yeah, that was something new.
Like Bitcoin is like new.
Right.
We might say it's ephemeral, but it's been around for a while now.
Definitely nobody had thought of it before, at least to get it to the point where it was practical.
Well, and where people were willing to self-organize around it.
But we did have DigiCash, which was halfway there.
And
almost
Eagle
worked. Eagle,
almost worked. Like, so there were like incremental steps to getting to it, but the non-hierarchical confirmation of transactions, like that was the major advancement over DigiCash. My first crypto project was in the 90s working on a paper on patenting the means of value exchange. And one of the patent families we covered were the David Chaum DigiCash patents. And even as somebody who had done some work at the periphery of the RSA patent litigation, like I still remember it. Like it was cool. Like those patents were cool. You could create a token and transact it over an open network, and you could be confident that the value associated with those couldn't be destroyed between send and receipt. Like that's pretty awesome.
Controversial too. The idea that
Yeah.
you can patent mathematics was
Yes.
anathema to many people.
Yes. Still is to some. But.
I'd say the composability component can't be like overstated. I think that is a huge kind of step up from kind of the various and disparate applications that we use. I mean, one of our partners, as an example, is developing an app that you have access to a tokenized money market fund and have your cash in that fund, and at the same time are able to basically pay for things via Apple Pay using your tokenized money market fund, because it automatically converts that into stablecoins into fiat. And so the composability component, I think, is something that is truly revolutionary. The other thing I would just say is there's been, in the grand scheme of things, 2 years of DeFi innovation compared to 100 years of traditional finance innovation. So in the grand scheme of things, we're still early days. But
I would throw out that you can design a business that blurs the distinction between investors, customers, employees, and suppliers. And I think we can come up with some entirely new business models that are much more palatable, especially to younger workers who are pandemic-freed from offices and hierarchies.
Matt, any thoughts on that?
No, I mean, my thoughts are aligned with Morgan's. I think composability, I think combining different things, you can, achieve something that's sort of more than the sum of the parts. I think that's intrinsic to a lot of the sort of blockchain ideas, and it's also, feeding on that, like the permissionlessness, like the fact that you don't need to ask permission to interact with various smart contracts and different kinds of protocols. And I think, again, thinking back to what is the alternative, which in my mind is really sort of centralized tech monopolies, which are, not intentionally not composable, intentionally very permissioned, and, I think will restrict innovation.
So is your sense that these mechanisms will like fundamentally change the way we might even think of asset management or the structure of businesses, because we'd be able to use, sort of break free from these traditional ways of thinking about corporate structure, or whatever?
Yeah, I mean, I think to Aaron's point, I mean, I think we are seeing that. We were starting to see that with the rise of DAOs, distributed autonomous organizations, which basically, people can contribute assets, and you can come up with very complicated rules on, how those assets are controlled. Complicated in a good way in terms of, sort of creating incentives and so forth. So I think it opens up a whole realm of, listen, in academics, there's a whole realm called mechanism design, where people come up with, sort of very complex mechanisms and maybe solve partial differential equations to sort of figure out how things should be balanced and, so on and so forth. And if you think, well, how might someone implement that? It's not going to be in a legal contract, right? So some form of, more programmatic interaction, I believe, will become dominant. And it will allow more complicated things than simply having, employees and shareholders and creditors and so on.
Yeah, and I think that's one of the most interesting aspects of this technology. I am a little bit of a cynic, though, in the sense that while we are removing some intermediaries, we've already seen the tendency just to create new intermediaries, because people are always going to be trying to capture economic value by putting themselves in a position to do that. So I think it'll be very interesting to see how this decentralized concept can survive in a world where people are seeking to create, monopoly profits at all times. Should we start taking questions from the audience? Just raise your hand and go here.
So obviously crypto has brought a lot of innovation and has given the opportunity to rebuild a lot of things from scratch. So having kind of talked about the advantages of crypto, do you think there are maybe things that crypto still needs to learn from more traditional markets and that would, let it become even more powerful?
I mean, how to get along with regulators. I mean, that's just been a disaster.
I would say more the opposite, that crypto needs to free itself from some assumptions that people made in the traditional world and get away from it. Granted, many individual innovators in crypto have been foolishly optimistic or unaware of history. But as a technology, I think it has to find its own logic and go its own way, and people like it for what it is, or not.
Okay. Follow up, or are you?
No, just thank you.
Right here?
Thank you for being here. So I have a question around the nice investment vehicles provided for retail market, because we have seen like the first crypto wave around the crypto trading, right? Because people wanted to make money like more easily, more fastly, whatever. And like, what do you think about like this next crypto investment product? So for example, we have talked about KKR's fund, but it's not for retail customers right now. So I was wondering what you think about, like, for example, tokenized euro bonds or dollar bonds, especially for emerging markets. Like, do you think this is a trend you'll see, or like what other retail-oriented investment products you expect to see?
Morgan, you want to?
Yeah, sure. So I think just in general, and something that I mentioned earlier, there's certain things that are being tokenized that are very clearly securities. And just because we tokenize them doesn't mean we can get around the laws. So there's very clear securities laws in the US and globally. And to your point, very much so, it's not fit for all investors, whether it's institutions or retail. And so while, certain individual investors, whether they're accredited or qualified purchasers or retail or institutions, I think we all, want to ensure that those investments are fit for purpose and fit the risk profile and so on and so forth. And so from our standpoint, we're the underlying technology that powers the access to and purchase of these things. But to your point, they're all, most of them are still intermediated by third-party infrastructure providers that have the requisite licenses, broker-dealer licenses, RIA licenses, to be able to ensure that the right investors are investing in what's appropriate for them. And so, maybe we'll get to a point where investors might be more educated on the opportunities and options out there. But to your point, you still need to kind of abide by the requisite laws, rules, and regulations, particularly around like obviously consumer protection, but also, investor risk and appropriateness.
So, one of the things that I think is interesting here is that if we think about tokenization more broadly as a way of changing the way we transfer property, in a sense, that's going to require change to some of the basic underpinning laws that we have to allow digitization. And I know, Tom, you've been following this question. Do you think there is momentum towards essentially adopting the idea that tokenization is a good idea, regardless of anything else in crypto, and we need to change laws to do that?
So in the United States, we clearly need to change the laws to do that. There is a project that has been underway for several years under the auspices of the Uniform Law Commission, which is the organization ultimately responsible for the Uniform Commercial Code. Anyone here ever heard of the UCC?
Every time you do anything, you're actually, acting with it.
You're interacting with the UCC.
Yeah.
And the revisions to the UCC have gone out to the states, sit before now 21 state legislatures. There have been some objections from some of the more extreme ends of the crypto ecosystem to those. They will ultimately get enacted and adopted across the 50 states and allow for the digital tokenization of various forms of assets, including intellectual property, something that Aaron alluded to earlier. And I am optimistic that they will substantially reduce transaction costs for everything from how we move money to how we transfer copyrightable but uncopyrighted works of literature, music, and art. So.
May I add something? I would say
Yeah.
a key distinction here is financial products that are sold versus those that have their own native investor demand. It is virtually impossible to sell a security without doing a lot of regulatory issues. So very important financial innovations like money market funds, index funds, 401ks were things that investors saw and figured out ways to get to and maybe cut a few regulatory corners. But the regulators eventually came on board with because there was so much real retail demand. So if you come up with a new idea that is so good, investors find you, that may be the vehicle.
A quick follow-up. Maybe not the funds, but what about US Treasury bonds, which are usually accessible for public, but if you don't met with the minimum investment quota, or if you're in another country, you cannot invest in bonds that easily.
Well, for U.S. Treasuries, it's only $100, but you go to Treasury Direct. So it's for a U.S. person, it's very easy. It's very retail friendly. I don't know about foreign countries.
Yeah, I would say just in general, when we see a very wide variety of projects that are looking to tokenize stuff, there's an infinity amount of things out there to tokenize, and it is their demand there. And oftentimes when we talk to projects, we ask in terms of having them outline their value proposition is what you're able to offer a new asset class or access to a new asset class or investment that people can't get elsewhere? Or is it being offered more cheaply than in the traditional means, or is it providing a much higher yield? And if the answer is no to all of those things, then it's really tough to provide a value proposition of why one outside of the crypto native world would want to or would be willing to go through the barriers to entry to actually access that thing. And to your point, a lot of the times the answer is yes, as it relates to potential investors in emerging markets. And so I think just in thinking about why someone would want to tokenize something, I think it's generally to answer one of those questions where historically potentially someone, whether it's an institution or individual, might not have had ready or low fee access to that investment.
I'd add, it seems that part of the question you're asking is availability of dollars more globally, right? I would say, I don't know that you need crypto as we've defined it in various definitions to do that. But B, yes, I think that is an eminently investable hypothesis. I wish that I was invested in Deal, for example, right, which is doing that. And I think that trend, I mean, one, and this has nothing really to do with crypto, right? It's just, if you look at global trade dynamics and the emergence of and support for e-commerce marketplaces around the world and the availability of relatively small businesses to access those markets, like, you know, there are manufacturers in the US, right, who have large numbers of consumers in Brazil and Argentina, and vice versa. And so that then creates sort of, as you have both suppliers and vendors who are dealing with dollars, then you're going to want to have easier access to dollars. And I think that trend is very, very real and definitely investable.
In the back there?
Sure. In regards to working with regulators and laws being changed, it feels a little bit like wanting your cake and eating it too, right? Because reading Satoshi's white paper, it feels like the entire premise of blockchain was to almost circumvent the need for trust. And I think of trust as, you know, if all else fails in this contract, in this relationship, we can go to the US government or state government and they can adjudicate this for us. So it feels like, I mean, I love Mr. Brown on the left's thoughts on this, because if you can create something, an entirely new service that, you know, trust couldn't enable before, that's great. But otherwise, it feels like you're circumventing the laws when it's not necessary. And like the cross-country border payments is a great example where oftentimes the rules and what's difficult is put in place on purpose almost to prevent, you know, KYC or AML or money laundering issues. So
Yeah, so a range of thoughts on that. I guess the first is I'm thinking about compatibility. So just to take one example today that I have spoken about and sort of written about and distributed among a closed circle, haven't spent a lot of time talking about it or writing about it publicly. So when I send Bitcoin, a Bitcoin token to your address, you presumably assume that because you control it, you own it. It turns out that assumption is not true under existing US law, because that token is a general intangible. And if there is a party that has a security interest against my assets, and I ultimately default on that instrument, they can actually unwind that transaction and get that token back from you if they can prove that I had it at the time, that it was part of their financing statement. And so to me, at least at this point, like much of the existing crypto economy looks like this giant proof of concept that isn't actually working as a legal matter in the way that people think that it is working and would like it to work. So we have to change the law so that it can actually work the way that people think that it is working. And fortunately, that the hard work of that compatibility has been done and now sits in front of 21 state legislatures since it was vetoed by the governor of North Dakota in her infinite wisdom. It's not, by the way, introduced in Florida, though at least in its current form, Governor DeSantis says he'll veto it too. Fortunately, the people who've been hard at work at this for the last 22 years have a set of accommodations that they can make to address what appear to be the core objections. But so like, we need things from a legal perspective to work the way that people think that they're working. So we need to do that. I don't think of that as cake and eat it too. I do think to something that Aaron said before, that it is important for technology to sort of follow its own path. And sometimes it takes the law a while to catch up with regard to sort of global trade and the access of non-Americans to US financial instruments. There is, like, that is actually legally possible. It's also possible operationally. It's not done as much as it could be, but that is a risk decision, not a legal decision, if that distinction makes sense.
I would add something here that I think there's a long-running debate within the crypto community as to whether we want crypto to be accepted by regulators and recognized by law. and, easy movement between Bitcoin and cash and US dollars. Or if we would really rather have these things separate, where the whole thing operates underground, and you can't easily move these things around, which is healthier. A lot of crypto true believers want an economy, they want to have their own country, and their own life. I'm agnostic on that. I can see arguments both ways. A lot of regulatory accommodations seem to take the life out of things. On the other hand, running a complete outlaw system seems like there's going to be a showdown someday. So I don't know the answer to that.
Yeah, it's the CSED theory, right? Back here.
So Professor Brown, you spoke about the third hybrid systems, which may essentially create the new services where you could basically onboard like millions of users to be the most promising of all the three use cases. So in that, I'm curious about what do you think would be the role of central parties or agencies who have created such protocols or products, because if you see to bridge the gap with the end consumer, you might need someone to take up that responsibility. Or do you think there are like decentralized applications or DAOs who would be able to still do this with the help of tokenization or any other method to be able to rouse such kind of interest in such kind of new products?
Well, just to be clear, I don't necessarily think these are the most promising projects. I think these are the projects that will define the future, because they're essentially crypto and essentially currency, both. I really don't know, to tell you the truth. Nobody's really done a good, large-scale thing like this. But I'm thinking of these projects that raise money by selling tokens, but most of the tokens are internally used in the project, either burned or created in the project by people who don't have only one role. They don't only receive tokens or only create tokens. They do both. The trouble is the really decentralized ones seem to break down or get hacked. And by the way, most of what you read about something getting hacked is usually an insider stealing things. It's seldom a clever computer expert taking the money out. The ones that are more centralized often have shown shockingly bad judgment. The user group, the control group gets narrow and starts pursuing its own thing. So maybe we need a more traditional, reliable control mechanism, a foundation, for example. Many of them have foundations, but they seem to fight with each other all the time. I don't know. Or maybe somebody really needs to make a decentralized thing with incentives and protections at work. A lot of work to be done in that area.
Okay, anyone else? Back here?
Hi, I wanted to ask, in the next few months or in the next year, where do you see more capital being deployed? In which area of the whole ecosystem do you see more future to attract investments?
I'm not seeing a lot of new capital at the moment, and I think it'll be at least a year, but maybe some of you have better access.
Sure. So we actually have an internal venture fund called Blizzard that invests in projects that have strategic alignment with the Avalanche blockchain. And from our standpoint, I think we're seeing new protocols, frankly, launching across all different types of verticals. From my standpoint, again, the idea of asset tokenization, real-world assets, protocols that are kind of twofold. One, trying to bring more real-world assets on-chain to really diversify the token mix of the on-chain ecosystem from straight crypto to assets that are less correlated with straight cryptocurrencies that provide, they call them real yield or real utility, i.e. bringing in financial instruments or other types of instruments from the off-chain world, those types of protocols, as well as, frankly, institutional grade protocols. So builders that have deep traditional financial services experience, that have structured product pricing experience, exotics options pricing experience, coming into the space and building enterprise grade protocols to facilitate greater institutional capital in a way that is compliant and able to facilitate, institutional adoption is what we're seeing, I would say, increased interest in from our perspective. But I'm sure you have interesting views on that as well.
I'm not sure they're interesting, but I'll give it a shot. One topic we haven't spoken about today, and is this has a regulatory push, actually, which I think is kind of interesting. So if you look at the European platform regulation, it has a number of elements that sort of align with some of the things that Professor Seemack outlined. But so access, open system architecture, and transferability of sort of core attributes. So what that sounds like to me when you sort of look at what the EU is sort of thinking about in terms of a digital future, kind of seems like ownership of digital assets. So an evolution away from a license structure, which is how we interact with our digital overlords today. And please, Apple, don't cut me off. To an ownership world where we would have direct and sort of permanent control of our identifying attributes. That seems a lot like Web3. And so architecture related to wallets, infrastructure to read across different protocols, right? Because they all are just databases. Ensuring the composability and the transferability of assets from one database to another database. So I think, think like the Java, right, of the crypto ecosystem, right? So smart contracts that can run across different L1s just as easily as they do on the one that they started on. Like, these things seem like kind of important if we're actually going to live in a world where we as humans and as firms own our digital attributes.
Any last question? Otherwise, I'm going to ask Seemack to give us a few last words, as he's the guy here who is driving things at Columbia Business School in this area. Or do you want to ask a question?
This is a very quick one, just
Sure.
a sort of clarifying remark based on a question that my friend had at the back. And you sort of tangentially alluded to the fact that there is obviously a problem of a lack of education among politicians, regulators. Just curious to hear kind of your characterization of whether that's actually a genuine concern about, hindering progress in the industry, a lack of education.
Yes, I think two things are hindering progress on this. One is, in case you haven't noticed, we are in the United States and around the world deeply polarized and disagree about things just for the sake of disagreeing about them, even if we actually kind of agree on them, which is kind of nutty. That's not helpful. And then the second is that there are aspects of this that are to use a term from Robert Heinlein, hard for people to grok, right? And so I think that has hindered the adoption of these technologies in different industries. And I would say the financial services industry is probably the poster child for that. We've had extreme volatility in the interest on the part of our core financial services regulators in these technologies. And that I think is not good from the standpoint of the industry as a whole.
Can I tell a story about that? Short story. This is back in 2014, and the Securities and Exchange Commission has done their first prosecution of someone for defrauding people out of Bitcoin. And at the time, there was really no legal understanding of what it was, and so I called up some people I know at the SEC, and I said, "Are you going to prosecute people for cheating at Monopoly?" The story is, I got a very interesting conversation. I met a group of people at the SEC who were extremely interested in this stuff, who knew about it as much as you could know about it at the time. Their motivation as securities lawyers was this could be a really hot area, and we want to, be...
They're all at private law firms here making $2 million.
Well, unfortunately, I think they might have bet a little wrong. I don't think the area was as hot as people thought it might be in 2014. But yeah, that's how you work if you're an SEC lawyer. My general experience over 40 years of dealing is you can find regulators who are knowledgeable, who are interested, who will have good conversation. Whether that actually translates up to the top to meaningful reform is completely, you talk to the SEC commissioners, it's a totally, not that they're stupid, but they have completely different view and attitudes, and what their staff members tell them doesn't seem to count for a lot.
Well, one of the ironies here is, perhaps Satoshi had it wrong, because if blockchain technology had been applied outside of financial services first, financial services is the most regulated thing we have. It's the most dangerous, right? And this new technology with its scary aspects, embedded itself immediately in financial services, whereas if it had started in something much more mundane, we might not feel, have had a lot of this unnecessary excitement about some of the applications that we're talking about now. Any last words about on behalf of the Brigger group?
Yeah, so, speaking as a director of the Brigger Family Digital Finance Lab, I just want to emphasize crypto means a lot of things to a lot of different people, including the people who invented it. So, there's an aspect of it that's, sort of this anti-government libertarian idea. There's an aspect of it with certain ideas about economics and inflation and should the government print currencies. There's an aspect of it that's like, this is the latest way to get rich quick, right? So I think there's all of those, and it generates a lot of noise. In my mind, the core aspect is a technology. And, I think what I'm certainly trying to do is understand what that technology does, what it's good at, and where it can be applied. And I think, to some extent, now we're in a bear market. Everyone's negative about crypto. I think, maybe there was too much irrational exuberance a year or two ago. In terms of in the bull market, we sort of had the opposite problem. So, my view is, let's try to understand the technology and what it can do.
Great. Well, thank you, everyone, for coming tonight. This was, I found it incredibly interesting and learned a lot, so I hope you all enjoyed it. Thank you.